If you have invested in the stock market and want to know what is the tax implication for the profits that you have earned on the sale of shares, or if you have made any losses and want to know what are the tax implications for those losses, then this video is specifically for you. Watch it till the end. Taxation on sale of shares on which securities transaction tax has been paid. So you generally pay STT when you sell the shares in the stock market, right? So if you have earned any gains by selling the shares, it will be called as capital gains, and this capital gain can be classified into short-term capital gain or long-term capital gain. Just for reference, I have mentioned this income tax section number also. For short-term capital gain, it is 111A, and for long-term capital gain, it is 112A. When will it be called a short-term capital gain? When you have sold the shares within 12 months of purchase, then it will be called as short-term capital gain. And when you have sold the shares after 12 months of purchase, then it will be called as long-term capital gain. For short-term capital gain, the tax rate at 15% will be applied. This is a special rate and which is irrespective of the tax slab in which you are in, right? And the same way for long-term capital gain, a special tax rate at 10% will be applied, but this is only if the long-term capital gain is more than rupees 1 lakh. So if your long-term capital gain is less than 1 lakh, there will be no tax, right? Now, say suppose you have sold the shares, but you have not made any profits. Instead, you have made losses. How will those losses be treated? So the same way as we saw for capital gains, the capital losses are also classified into short-term capital loss and long-term capital loss based on the period after which you have sold the shares. If you have sold the shares within 12 months of purchase, it is short-term capital gain, and if you have sold the shares after 12 months of purchase, it will be called as long-term capital gain. Long-term capital loss, right? So now if you have made short-term capital loss, it can be offset against short-term capital gain or long-term capital gain from any capital asset. Say for suppose you have made a short-term capital loss of rupees 2 lakhs, and in the same year you have made a long-term capital gain of rupees 3 lakhs. So this short-term capital loss of 2 lakhs will be offset against the long-term capital gain of 3 lakhs, and the net capital gain for that year will be a long-term capital gain of rupees 1 lakh. Understood? And in the same way, if you have made a long-term capital loss, this can be offset only against long-term capital gain from any capital asset. Any capital asset means it can be shares, or it can be house property, or it can be equity oriented mutual funds. All those are capital assets. So the main point here is short-term capital loss can be offset against short-term capital gain or long-term capital gain, but long-term capital loss can be offset only against long-term capital gain, which means if you have made long-term capital loss and short-term capital gain, you cannot offset this loss against this gain. This is not allowed, right? If you have not offset that loss in that financial year, which means that you have made any loss in that financial year but there is no gain to adjust against which, then you can carry forward that loss for the next 8 years, and you can adjust that loss in any subsequent years you make profits. But this carry forward is allowed only if you have filed the income tax return within the due date. Like suppose for individuals your due date is 31st July. So if you file the income tax return only within the due date, you can carry forward the loss for the next 8 years. Let us understand this concept with a simple example so that you can have a clear understanding. Say suppose in year 1 you earned a long-term capital gain of rupees 5 lakhs and short-term capital loss of rupees 7 lakhs. So as we know, short-term capital loss can be adjusted against long-term capital gain. So after adjustment, the net short-term capital loss for that financial year is rupees 2 lakhs. Since it is a loss, it will be carried forward to the next year if you have filed the income tax return for that year within the due date. Now, in the next year, say suppose your long-term capital gain is rupees 2,50,000. We have already seen that long-term capital gain is taxable only if the gain is more than rupees 1 lakh. Here, in this case, since the gain is less than rupees 1 lakh, it is not taxable. Right? Hope this example is clear to you and the concept as well. Hi, I see Rahul Jain. Hope that this video gave you some useful information which you always wanted to know. Stay connected for more such informative videos. Thank you.